Good morning and welcome to today's Five with Fitz. You know, one of the things that I love most about investing is that it is a constantly changing puzzle. There are always new headlines and new bits of information that you can do something with. Like this one, where I literally said to myself, hold the press! Treasury Secretary Bessent has said that we now have the makings of a deal with China, a story that's breaking as I record this. So, good and right on cue. Why do I say that? Because that'll bring a whole lot of money running that should have been there in the first place. Like, oh, I don't know, last April when I told you to buy into the worst of the sell off because there would eventually be a deal. And I hope you did. Why? Because the S&P 500 has tacked on 25.69% since then in a matter of months. And many of the companies that we talk about regularly have done considerably better, which is, of course, why I encourage you to own them. And the OBA family tell me they do. So what's next? Well, that obviously depends on the deal, but we'll cross that bridge if and when there really is one and we get a look at the terms. Meanwhile, remember something that I have told you repeatedly so that you can prepare for the next pullback and have a smile on your face too. If you are not investing when the chips are down, you will not be ahead when they're up. Simple as that. Here's my playbook today. Number one, Nadella's in your face power flex. Microsoft's earnings call yesterday was a masterclass in world-class execution. Q4 results included revenue at $76.44 billion, EPS at $3.65, also a beat. Net income $27.2 billion, up from $22 billion year over year. Azure $75 billion plus in annual revenue, up 34%, and Q4 growth 39%, an absolute monster. And as usual, it's not the earnings themselves that are the real story. Microsoft revealed the dollar value of Azure for the first time ever. Again, that's 75 billion plus in revenue with a B, and year over year growth of 34 plus percent. Now, to be clear, they didn't have to. Microsoft did so because they wanted to, because the numbers are finally strong enough to be a full-on, in-your-face power flex. Azure's strength isn't about the cloud anymore. It's about AI, exactly as I have repeatedly suggested would be the case since the moment I first heard about it. Microsoft is building a productivity machine that is powered by artificial intelligence, and it's already rewriting the company's entire business model. Case in point, CEO Satya Nadella said that 30% of Microsoft's internal code is now AI generated, all of which produce a trifecta of investing multipliers you've heard me mention many times over: margin expansion, time compression, and return to scale. Now, I expect that figure to be 50% within a few years, and that's probably being conservative, by the way. Anyway, the reason I want you to understand this is that I cannot understate how important this concept is to your investing. And I'm not just talking about Microsoft here. I'm talking about any company. Every company on the planet will adapt, adopt, or die when it comes to AI. Traditional rules collapse when AI starts building AI. Revenue increases, expenses fall, speed rises. Entire product cycles compress from quarters to weeks, maybe even days. This is not theory, and it's happening right now. Now, unbelievably, I still see so many folks grousing about when is AI going to monetize or some other baloney like that. And I cannot help but shake my head every time I hear it. The answer is increasingly, undeniably, right flipping now. Now, to be clear, I don't hold it against any of them. Change is uncomfortable. But I do feel bad for these folks because the simple reason is that anybody who's not on board risks missing everything, not just missing out. AI will go down as the greatest investing theme in recorded human history, a statement I have made repeatedly over the years, including many major network appearances like this one you can watch elsewhere on my channel with the super savvy Kelly Evans. Now, remember, we're on the cusp of the sixth wave. This is on par with steam, locomotion, distributed generation, penicillin, the internet itself, only it's accelerating bigger, higher, and faster. Now, if you've got this covered, great. And a lot of folks don't. If you want something and you want some help, I'll be here. You know where to find me. Number two, Powell served up another nothing sandwich. And I can't say I'm surprised. Fed Chair Jerome Powell, it's transitory, and that guy, Jerome, it's transitory Powell, decided to leave rates unchanged. Now, it just defies the imagination. But I mean, talk about a nothing sandwich, right? As an investor, the Fed is a sideshow at this point, in my humble opinion. Number 3, I told you Meta would be the fireworks this week. The Venerable Stuart Varney asked me ahead of Monday's opening bell which big tech earnings of those reporting this week would get the biggest reaction. Meta, I said in no uncertain terms after he put me on the spot. Looks like I might have been onto something, or on the money anyway, pun absolutely intended. And no, I still don't own it, doggone it, but my hat is off to everyone who does. Question on a lot of people's minds, certainly on my mind anyway, is it time to give Meta another look? Well, maybe. I mean, I personally still prefer the backdoor approach for now that I've shared with the One Bar Head family, but I'm delighted to give credit where it's due. This was a strong quarter from a company that is starting to act like it wants a seat at the grown-up table. So good job, Zuck. Keith's investing tip. It would be easy to feel regret in a situation like this, and a lot of folks do. But I've found that that's not very useful in the scheme of things over the years. Investing isn't a competition. You can't own every great stock that tickles your fancy, and long-term success comes from finding and buying and owning great stocks that meet your goals, your objectives, and your situation. Meta simply hasn't met mine yet. But, to be fair, I have a sneaking suspicion that day's coming. Anyway, number 4 today. This is exciting, but Waymo's now got a serious Tesla problem. Waymo's been cruising slowly with regulators and robotaxis and limited geofencing. And there's a constant, nonstop debate, is Tesla better, is Waymo better, is Tesla better, is Waymo better? Well, I don't really care. What I care about from an investing perspective is that Tesla's just dropped the clutch. Elon's rolling out robotaxi service in Austin this year with plans to hit 25 cities within 12 months. No LiDAR, no geofencing, full send. So here's an investing tip to think about, right? First mover often wins, but fast movers often dominate. And if you can find both in one company, well, yeah, it's a pretty short list. Anyway, trade idea in this instance, consider buying the rumor than trailing a stop, or short legacy automakers still stuck in first gear. Personally, I'd buy putskis on Waymo if I could, but it's still privately owned by Google. Darn it. At the same time, I think this will pressure Uber and Lyft. Probably more Uber than Lyft if my gut check is correct. Number 5 today, CVS just pulled a hat trick and a half. CVS shares are jumping this morning on the heels of a double, meaning a top and a bottom line beat. Strong guidance, of course, helps, right? It's funny how that works. But the company now expects $6.30 to $6.40 in adjusted earnings per share for the year, up from $6 and $6.20 as a range. That's not a small bump. That's a big bump, and it's a hat trick. Should you buy it? Well, like many things, that depends on how you see the company's future. I think there are bigger fish to fry personally. Pharmacies, in my opinion, are going to get reinvented in the next few years, along, of course, with our entire healthcare system, and I am hard-pressed to see any massive game-changing opportunity here at the moment. Today's bottom line, all investments have risk, but not all risks are worth the investment. So, choose wisely. You got this, I promise. As always, let's make it a great day. Thank you so very much for joining me today, and I will see you again tomorrow.